Now, this past quarter has seen sharp falls and increased volatility across most risk-seeking asset classes, resulting in what must be the worst period now for markets since the European crisis 4 years ago. Now, really, the largest falls have come in August, which on the face of it appear to have been triggered by a fairly modest devaluation of the Chinese currency. But really, it's been on the back of mounting evidence of slowing global growth, especially in emerging markets. Now, EM countries have had to contend with numerous strong headwinds of late. We've had sluggish global growth, the challenges of containing or reining in a credit boom in some emerging economies, strong US dollar, policy mistakes, Brazil being a great case in point, and quite evidently, a slowdown in China. Now, to us, the biggest driver behind the slowdown in China has been the huge overcapacity in many industrial sectors that followed from an enormous fixed asset investment program over the past 15 to 20 years. And the rebalancing of the Chinese economy towards consumer and service sectors has meant a cutback in capital spending. This has clearly impacted demand for many industrial commodities, and we've seen substantial falls both in commodity prices and the value of resource producers. Now, the Fed's decision to keep interest rates on hold was in all likelihood responsible for a further leg down in markets in September, seemingly confirming to investors that the FOMC are also concerned that growth may be slowing, and therefore the risks of a recession are increasing. Now, all in all, UK equity markets ended the quarter 7.5% down, with developed equity markets, hedged back into sterling, down just shy of 8%. The largest falls came in emerging markets. The MSCI Emerging Market Index in sterling terms, a hefty 15% lower over the quarter. Now, credit wasn't immune, with high yield down 5%. It's really just UK government debt, your traditional safe haven asset class, that provided some protection during the turmoil. In the face of rising deflationary fears, returned close to 3% for the quarter. Now, against this backdrop, our diversified target return fund fell by 4.5% over the third quarter. This sharp increase in volatility and risk aversion meant that we experienced very little diversification benefit from the different positions that we hold within our portfolio. Really, it's only been developed country government bonds that have provided any protection, but we continue to view the asset class as expensive, with little prospect of generating any real return over the medium term in all but the most pessimistic of economic scenarios. As a consequence of that, we don't have any direct government bond rate exposure in our portfolios today. Now, the performance of equity markets, and particularly emerging markets, have had the most significant bearing on the portfolio. Our emerging market exposure today is around 6.5% of the portfolio. That was the largest attractor. It contributed about 1.2% to the overall performance outcome. Now, we experienced a very similar result from our developed market equity exposure, which has a bias towards the UK, and that was also down 1.2% in aggregate. Pleasingly though, our quality or our franchise-orientated equity managers were able to hold their ground over the quarter. As I said earlier, credit wasn't immune, and our high-yielding managers experienced the brunt of the sell-off. In aggregate, our credit-orientated strategies, which encompass high-yield loans, emerging market debt, and convertible bonds, all detracted a further 1.5% over the quarter. So what changes do we make? At the end of July, we added at the margin to our existing positions in convertible bonds and US high yield. This was in part funded by a small reduction to our quality-orientated manager, but also through cash. Now, it was really at the end of August, following the substantial sell-off in markets, that we made a more meaningful change to the asset allocation of the portfolio. We sold the majority of our position in our short-term enhanced yield strategy, and we increased our position to US high yield bonds to take our total US high yield and loan exposure to around 30% of the portfolio. Also, given the sharp sell-off that we saw in UK equities, we've elected to increase our exposure to our UK quality-orientated manager, which is even load, to take our total quality exposure in the portfolio to just under 10%. Now, this sharp correction in markets and the accompanying rise in volatility certainly raises concerns for the state of the global economy and the deflationary forces that are continuing to build. We're clearly entering a difficult and a challenging period for the global economy. Now, China is also on this path to rebalancing its economy, and And that's ultimately going to be a positive development, even though in the short term, the effect on markets is probably going to be difficult. Central banks will need to maintain exceptionally loose monetary policy. And for us, it appears unlikely that the Fed will raise interest rates this year. Now, the good news, in our view, is that markets have rapidly adjusted to slowing growth and probably fallen further than fundamentals would suggest. We believe that we passed the worst in this latest risk-off period, although with significant imbalances and a high level of uncertainty, it's likely to see volatility remain elevated for some time. But we're long-term investors, and this heightened volatility will also present opportunities for us to add to positions at attractive levels in the future.